All right, let's get straight into it. We have to talk about Nuburu, ticker symbol BURU. As the market is closed for the weekend, we're looking at the closing figures from Friday, October 24th, 2025. And what a session it was! Nuburu finished the day at $0.40 per share. That was a massive surge, closing up 0.0589 or 17.27% on the day. The volume was simply staggering, with over 232 million shares changing hands. This isn't a quiet move. This is an absolute stampede of speculative interest. Now, when you see a nano-cap stock, which was trading near its 52-week low of 12 cents not long ago, suddenly ignite like this, the immediate assumption, the expectation, is that the company has been saved. The market is trading this like it's the next big thing, based almost entirely on a press release from a few days ago about a new defense joint venture targeting a multi-billion-dollar drone market. That is the story. But the hard reality, the one you find when you look past the headlines and into the actual financial statements, paints a picture so starkly different it's almost dizzying. The reality is this company is, from a balance sheet perspective, in an incredibly precarious position. This $0.40 price isn't just about a drone contract. It's a high-stakes bet on whether a company with negative shareholder equity and a history of compliance issues can pull off a miracle. Let's first break down the recent action, because this move is the whole story. The fuse was lit on Wednesday, October 22nd, when Nuburu announced a strategic framework agreement with a company called Maddox Defense. The plan is to form a joint venture to build and sell advanced drone systems for both military and commercial applications. The press release was filled with impressive numbers, targeting the NATO UAV defense market, which they estimate at $7 billion to $10.3 billion annually. The venture even put out projections of hitting $100 million in annual revenue by 2028. For a company of this size, those are astronomical figures. The market, particularly the retail and speculative crowd, saw this and the race was on. This is the kind of story that gets traders excited, the kind of narrative that spreads rapidly on platforms like Robinhood and SoFi. It has all the elements: defense, drones, and big numbers. This is what SoFi active investing and Robinhood stock trading thrives on, a narrative that promises explosive growth. The 232 million share volume day on Friday tells you that this wasn't a few institutions quietly building a position. This was a frenzy. But this is where we have to separate the expectation from the reality. This stock is not Tesla stock or Nvidia stock, where you're analyzing PE ratios and data center demand. This is a survival play. Let's look at the financial reality that was true right before this news hit. As of its last major filing, Nuburu's balance sheet was, to put it politely, a disaster. We are talking about a company with total assets of around $2.5 million, but its total liabilities were over $47 million. That means Nuburu has a negative shareholder equity of more than $44 million. Think about what that means. In the simplest terms, if the company sold everything it owns, it still couldn't come close to paying off everything it owes. Its cash position was reported at just over $111,000. That's not a lot of runway. In fact, its cash runway, based on its free cash flow, was calculated at effectively 0 months. The company has been and remains deeply unprofitable, with both revenues and earnings in decline over the past year. This is the kind of financial health that Fidelity or Schwab Intelligent Portfolios would run from. This is not a component of Fidelity mutual funds or Fidelity ETFs. This is the absolute opposite of a stable investment. And the market knew this. This is why the stock was trading near 12 cents. The company has been in a long-running battle just to stay listed on the NYSE American. It has faced delisting warnings for its low stock price. In fact, just back in June 2024, it had to execute a 1-for-40 reverse stock split just to get its price back up to compliance levels. A reverse split is rarely a sign of health. It's a consolidation of shares to artificially boost the price, and it's a move that often precedes further declines. More recently, on October 13th, the company received another warning letter from the NYSE, this time for failing to properly notify the exchange of a material news announcement. This context is critical. This is not a healthy, growing company that just stumbled upon a new market. This is a company that was on the ropes, and this drone announcement is its Hail Mary pass. The 17% surge to 0.40 is the market betting that the pass will be caught. So what does Nuburu actually do? Or at least, what did it do before this drone pivot? The original expectation for this company was built on its blue laser technology. This is genuinely interesting tech. Their business is designing high-powered blue lasers for industrial use, specifically for materials processing. The key advantage is that metals like copper and gold, which are highly reflective to traditional infrared lasers, readily absorb blue laser light. This makes Nuburu's tech theoretically ideal for welding copper in EV batteries or for delicate work in consumer electronics and 3D printing. That was the story that took the company public via a SPAC. The expectation was that the EV boom would create massive demand for its unique welding capabilities. But the reality, as shown by the collapsing stock price over the last 2 years, was that mass-scale commercial adoption was painfully slow, and the company was burning through cash at an unsustainable rate. The EV and battery welding story, while compelling, simply didn't generate the revenue needed to stay solvent. This brings us back to the drone joint venture. This is where the expectation and reality have their final showdown. The press release sounds fantastic, but there is a catch, and it's a $10 million one. If you read the agreement details, it states that Nuburu Defense LLC, its subsidiary, will contribute up to $10 million in capital funding to this new joint venture. This is the central problem. A company with $111,000 in cash and $44 million in negative equity does not have $10 million to contribute. So where does that capital come from? It can only come from one place: selling its own stock. This massive 232 million share volume day and the 17% price spike are not just speculators buying, it is almost certainly the company itself executing an at-the-market offering, selling newly created shares into this frenzy. The drone news therefore serves two purposes. It creates a new growth story, the expectation, and it creates the volume and price spike necessary to fund that story by diluting the very speculators who are buying into it. This is a classic and risky financing maneuver for a company in this position. This is the absolute sharp end of online investment. This is not a stable holding for your Fidelity IRAs. This is a trade. People using the Robinhood app or the SoFi trading platform are jumping in, looking for a quick double. Many are likely buying Robinhood fractional shares just to get some exposure to the volatility. This is closer to Robinhood crypto trading than it is to traditional investing. The more sophisticated traders, perhaps those using interactive brokers, are looking at this very differently. They see the volume and the news, but they are also acutely aware of the dilution and the financial risks. An active trader on the interactive brokers platform might be playing the intraday swings, but they are unlikely to be holding this as a long-term investment. They understand the interactive brokers' fees are just the cost of entry to a high-stakes game. This isn't an intelligent portfolio pick. This is self-investing in its most raw form. So, here is the critical question, and I want you to really think about this. Comment below. Given the company's severe financial distress, do you think this drone joint venture is a genuine long-term strategic pivot, or is it primarily a survival tactic designed to create a news event to raise a lot of capital? Let's look at the future scenarios. The bull case, the one that 17% surge is betting on, is that this works. The expectation becomes reality. They successfully raise enough capital from this stock sale to fund their $10 million contribution. The joint venture with Maddox Defense is real. It lands a significant contract quickly, and the market starts to believe in that $100 million revenue projection. In this scenario, the short sellers who are betting against the company get squeezed, and the stock could, in theory, continue to run, challenging its 52-week high of $0.99. This is the lottery ticket scenario. This is what SoFi investing speculators are dreaming of. The bear case is that reality reasserts itself, and it reasserts itself harshly. The reality is that the company sells tens of millions or even hundreds of millions of new shares into this rally. This massive dilution provides a cash infusion, but it also puts a heavy ceiling on the stock price. Once the hype from the press release fades and the market remembers the $44 million in negative equity, the